Bull Bear Buzz podcast for decoding markets, fueling minds.
Ever feel like the big economic picture is, well, a little too big? Hard to grasp.
Yeah, for sure.
Well, today we're doing the opposite. Zooming in. Way in!
Okay, I like it.
To something that has touched millions of individual lives in India. Microfinance. Since 2000, it's been quite the journey, right?
Huge story, yeah.
You shared a fantastic article on this, and our goal is to kind of unpack it. All the growth, the bumps along the way, and where things stand right now.
Sounds good.
Almost like, a cheat sheet to understanding a really vital part of India's development.
I'm all for shortcuts.
All right, so microfinance, at its core, we're talking about financial services, especially small loans, reaching people who traditional banks just wouldn't touch, right?
Exactly. Bringing financial tools to those operating outside the formal system.
But to really get the year 2000, we kind of got to back up a bit. Look at the foundation laid by NABARD.
Okay, good point.
So for those unfamiliar, that's the National Bank for Agriculture and Rural Development. Set up in '82, broad aim was to boost rural India. How did NABARD become this, cornerstone of the microfinance story?
They were pivotal, really. Their mandate was wide agriculture, rural livelihoods, the whole picture. But they saw the power of small loans early on. And a key moment, their 1992 Self-Help Group program, SHGs.
Okay, so SHGs, explain that a little.
Focused on organizing small savings groups, mostly women, and crucially linking them to formal banks. So by 2000, you had this SHG movement, proof that this approach could work.
So the stage was set, right, with NABARD and these SHGs.
You could say that.
And then the 2000s hit, and the article describes it as a rocket launch for microfinance. What was fueling that crazy growth?
Several things came together. The success of the SHG model showed lending to underserved communities wasn't just possible, it could be very effective. And this paved the way for microfinance institutions, MFIs, like Bandhan in 2001, Spandana's 40 in 2003, really important players.
So these MFIs took the SHG success and blew it up big time.
Basically, yeah. Often inspired by the Grameen Bank model in Bangladesh, they offered these tiny loans, no collateral needed, targeting mostly rural areas and women.
And the numbers from that era are wild. Loan reserves going from 1,000 crore in 2000 to 5,000 crore in just 5 years?
Yeah, that's a 38% annual growth rate. Insane.
And not just money, right? The article says borrowers jumped from 1 million to 5 million in that same time. By 2010, annual loans disbursed were 25,000 crore.
They even hit a peak in 2012, 17,000 crore total, over 25 million borrowers. Massive.
What's interesting is this boom seemed built on solid ground, right? Repayment rates above 95%, interest rates around 20-30%. Looked like a win-win.
For a while it did. People considered unbankable were proving they could repay. But it wasn't just willingness. The early SHGs had strong social cohesion that peer pressure helped. But as MFIs grew so fast and moved beyond these tight-knit groups, that social control weakened. That, plus some aggressive practices. Well, it led to a turning point, the Andhra Pradesh crisis in 2010.
Yeah, the article doesn't sugarcoat that. Overlending, intense pressure on borrowers, aggressive loan recovery tactics, it just got out of hand.
Fast. People were taking multiple loans just to stay afloat, a debt spiral. And tragically, some were so desperate, the article mentions reports of suicides due to the crushing debt. A very dark side to that rapid growth.
And the Andhra Pradesh government, they stepped in hard, didn't they, with that October 2010 ordinance?
They did. The Andhra Pradesh microfinance institutions, regulation, money lending, the whole thing.
So what were the key restrictions they put in place?
MFIs now had to register with authorities. No more strong-arm tactics for collecting. Loan repayments went from weekly to monthly to ease the burden. And a big one, government approval needed before any new loan. Plus, the article says there was political pressure, almost encouragement, for people to stop repaying altogether.
Wow, that must have thrown the whole system into chaos. The article cites $2 billion in bad loans, a huge hit to MFIs in the state.
It did. And while protecting borrowers, especially those in SHGs, was the goal, the way it was done destabilized the whole sector, at least there.
Right. Good intentions, but messy consequences. It showed the need for, national regulation, right, which is where the RBI comes in.
Absolutely. That's when the Reserve Bank of India took a more hands-on role.
So 2011, the RBI steps up based on the Mulligam Committee's recommendations. What did they do to regulate these NBFC MFIs, the non-banking financial companies doing microfinance?
They brought structure, more comprehensive rules. Interest rate caps were a big one, initially 10-12% above their borrowing cost, max 26% per year, though that's been revised since.
Okay, so limiting how much profit they could make off each loan. What else?
Loan size limits started at 50,000, now it's 1.25 lakh. And how much total debt one person could have, under 1 lakh initially.
So preventing people from getting buried in loans from multiple MFIs.
Exactly. Plus income criteria, so borrowers had some ability to repay. 60,000 rural or 1,020,000 urban at first, but those have been adjusted too.
It wasn't just about controlling the lenders, though, right? The article talks about borrower protections, too.
Right. Huge part of it. Limiting how many MFIs one person could borrow from, more flexible repayment options, no penalties for early repayment, transparency with all rates and fees.
And crucially, no more of those brutal collection tactics that fueled the Andhra Pradesh mess.
Absolutely. Gone. All about responsible lending, finding that balance between the MFIs doing business and keeping borrowers safe.
And it seems like this stricter setup helped the sector rebound, even grow. The article says the 2010s saw a recovery, with big MFIs like Ujjivan and Suryodaya becoming small finance banks after the RBI's 2015 initiative.
Yeah, that was significant. Evolving, becoming more formal.
Explain that. Becoming a small finance bank, what did that mean for them?
Went beyond just loans. They could take deposits now, more stable funding, not just relying on borrowing, and they could offer their clients savings accounts, other tools, a broader service, a sign of the sector maturing.
And even with the Andhra Pradesh setback, overall growth continued. The loan portfolio reached 1.2 lakh crore by 2017, still growing 30-40% annually.
That's right. The demand for microfinance remains strong. And it's important to note they diversified. Not just loans, but microinsurance, savings products too.
So kind of like a one-stop shop for financial needs.
In a way, yes. The article says this wasn't just a reaction to loan losses, it was a strategic shift. Helping clients with health issues, natural disasters, stuff like that. Started in the mid-2000s, picked up after 2010.
Makes sense. As they grew, they saw the bigger picture of their clients' lives. But then came some curveballs. Demonetization in 2016, the pandemic in 2020.
Yeah, those were rough. Demonetization disrupted cash flow, repayments got hit. And the pandemic, with lockdowns, job losses, income shrinking, borrowers really struggled.
Yet they bounced back. The article mentions digital tools helping, plus RBI support.
True. Technology and proactive policies made a difference. Then in 2022, the RBI even eased up on those strict interest rate caps. MFIs could set their own rates within limits as long as a borrower's total debt was under 50% of their income.
So giving them some flexibility, but with a safety net.
Exactly. Keeping that Andhra Pradesh lesson in mind. But this brings us to now, February 2025. The numbers are still huge. 4.2 lakh crore total loans, 8 crore borrowers, 1.5 lakh crore dispersed annually, still growing 25%.
From 1,000 crore in 2000 to this. That's the impact, right? And the article credits NABARD, government schemes like Yantan Yojana.
It's remarkable. But there's a but.
There's always a but.
The article calls it the 2025 crisis, says things are getting tight. What's causing this new worry?
It's the NPAs, right? Non-performing assets, aka bad loans, hit a whopping 50,000 crore by late 2024. That's 13% of all loans.
Oof, yeah.
Up from like 1.3% the year before. Not a good sign.
Not at all. And there are reasons. The article points to overlending without proper checks, borrowers taking loans from everywhere getting over-indebted, and the economy, high inflation, unstable jobs, especially rural areas, making repayment tough.
And we see it in the collection rates too, down to 94% in late 2024 from a solid 98%. Might seem small, but with such massive numbers.
It adds up fast. RBI is trying to crack down, targeting MFIs with high NPAs, but the article suggests it's not enough yet.
We're also seeing slower growth, down to 17-19% this year from 29% last year. Could be lenders being careful or just borrowers stretched too thin. They even mentioned ESEF Bank, their NPAs jumped to 6.9%.
A bad trend for sure. High NPAs can cripple these institutions.
So the article ends with a warning, calls this a wake-up call, says without stricter rules, better credit tracking, more support for struggling borrowers, we could be heading for another major crisis.
It feels like we're at another crossroads for microfinance.
Okay, so let's recap. We've seen this amazing journey from NABARD's groundwork, the SHG success, the MFI explosion in the 2000s, then the Andhra Pradesh shock, the RBI stepping in,
Right.
recovery, expansion, diversification, small finance banks emerging, and now this looming threat of bad loans. Quite a ride.
It has been. Microfinance in India, it's resilient, it's adapted to challenges. But the question now is, how will it handle this one?
It's this balancing act, right? Expanding financial inclusion, but keeping the whole system stable for the institutions and, more importantly, for the borrowers.
Couldn't have said it better myself.
You look at it all from those early small loans changing individual lives to this huge industry today with these serious problems, makes you think, what needs to change fundamentally for microfinance to survive long term, to keep having that positive impact?
Great questions.
Something to ponder, for sure.
Yeah.